Hi there, my name is Jeff Luke, and today I'm going to teach you how to figure out if the price you're thinking of paying for a stock is a fair price. And I'm making this video because I've noticed a lot of people lately are talking about investing in stocks and whether the stock price is going up or down and whether I should invest in this stock or that stock. But I think that there's a flaw with this way of thinking, and I'm going to tell you what that is. Instead of thinking just about the stock and whether it's green arrows or red arrows or up or down today or next week or next month, what you need to do is think about the fact that when you're thinking of buying a stock, you're actually buying a piece of a company, and you will become a part owner in that company. And I think this is a really important, fundamental way of thinking about investing, is to think about the fact that you're going to be an owner in a company, and think about valuing that company and figuring out what it's worth before you actually decide to buy stock in that company. And there's a quote here I want to share with you by Warren Buffett. He said, "It's better to pay a fair price for a wonderful company than pay a wonderful price for a fair company." And underlying that is this whole idea that you really want to buy shares in a company that you would want to own for at least 10 years and probably much longer. And if you get the company right, and it's a wonderful company, then paying a fair price is okay. What you don't want to do is get a wonderful price, like pay, a really cheap price, and just get a, so-so company. So the first step you want to take when you're thinking about investing is invest in a company that you understand and that is a wonderful company. Because if you buy a great company at a fair price, you're probably going to do really well over the long term. Okay, so what I want to do now is I want to actually show you how to figure this out on your own. So any company that you're thinking of investing in, you'll be able to do this. It's pretty simple, it's straightforward math, and I think once you get a grasp of this, you'll be able to get a much better handle on valuation or valuing a company. So it's a three-step process. There are really three things that you need to do to figure out the value, fair value of a stock that you're thinking of investing in. So the first thing is you have to figure out what you'd pay to buy the whole company. Why is that important? Well, you really want to think like you were buying something in real life. For example, if you were going to buy an apartment house, an apartment building, and rent it out to people, you wouldn't be too worried about the value of the apartment house from day to day, but you'd want to know, what are the rents that I'm going to get? And how much do I think the whole entity would be worth? Or if you were buying a farm or anything like that. So that's the first thing. Second thing is you want to find out how many shares of the company you're thinking of buying are outstanding. And what that just means is, the company has issued a whole bunch of shares to cover the ownership of the company, and whenever you buy or sell shares, you're actually buying or selling one of those shares. So you want to figure out how many in total the company has issued. And then there's the third thing you need to do. You need to divide the amount of money that you would pay for the company you'd pay by the number of shares outstanding. Okay. So there's only one thing you have to keep in mind here, and this is something Warren Buffett has talked about. When you go about doing this process right here, it's really important that you don't look at the stock price of the company you're thinking of buying, okay? So the reason for that is it will bias you. If you know what the share price is, if you know what it's selling for today, then it will influence your perception of the value of the company. So if you don't have any idea of what the quoted price is, you're going to be much better off when you do number one. So what I'm going to do is I'm going to give you a real life example of how you could do this with a company that everybody watching this video has heard of, and you'll be able to sort of see the steps, how I do 1, 2, and 3 for this company, and then you'll be able to do this on your own with any company, okay? So all right. So the company that I'm going to do here and show you how this works is Starbucks, since we've all heard about it. And I've done a bunch of research on my own, and I decided, I'll just write the company name here. Decided that for the amount I would pay to buy entire company, would be $80 billion. Okay? So then the next step is I need to find out how many shares are outstanding, and you can do that really easily. By the way, this is the first step I need you to do on your own before you even look at what the share price is. Once you've done that, you got to find out how many shares are outstanding. I looked this up online, and the number of Starbucks, this is the ticker symbol for Starbucks, shares outstanding, is 1.44 billion. Can't really see that one, so I will fix that. Okay, and then the next step is just to divide 1 by 2. So if you take 80 billion and you divide it by 1.44 billion, that's how many shares are outstanding, you get a share price of $55.55. This here is the fair value of a share of Starbucks company on a per share basis. That is the fair value per share. And if you just take a look at this, all we've done is taken what the company is worth, a fair price that you've decided based on research, reading, learning about the company, dividing it by the number of shares outstanding, and that means that's this many dollars per share. That would be a fair price. Now, once you figure that out, once you've figured out what the share price should be because of the math you've done and the research you've done by yourself, then you can take a look, go online or however you want to, and figure out what the stock is selling for. So I'm going to do that. I'm just going to erase this so I can update the info here. Okay, so we've decided here, just to recap, a fair value that we've decided is $55.55. Now when we look up the price, let's see here. Friday's closing price for a share of Starbucks was got it here. Bear with me. $52.70. So take a look right there. The price it's selling for is actually just a little bit below what we decided would be a fair price. It's 5% or so less. So right now, just based on this here, we know that if you were to buy at this price, if this is what you thought the company was worth on a per share basis, you'd be paying roughly fair market value, fair value for the company. Now I want to show you something interesting. Right, today is the 20th of August of 2017. Now, just like 2.5 months ago, so back in June, and by the way, I'll just put this here. This is the closing price on the 18th. Let's see, which was a Friday. So if we go back to June 2nd, closing price was, let's see here, $64.57. Now, if you multiply that out times the shares outstanding, the company was worth, at that time, this would be I should say this differently, the market cap of the company. It's not what the company was worth, but it was what the market cap, that's the share price times the shares outstanding, was $92,980,800,000. And today, based on the closing share price on Friday the 18th, the market cap is $75,888,000,000. So, if you take a look here, the price now of the company times the shares outstanding equals 75 billion. And just 2.5 months ago, Starbucks market cap was almost, what was it? It was about $18 billion higher. So, if you were to buy stock today or this week, as opposed to back then, you would pay a lot less. It'd be about 18% cheaper now than it was then. And you'd be buying shares of the same company. It hasn't changed much in a couple months, but maybe investors' perception of the value of the company or its future have changed in the last couple months, but probably not any massive change in a company in such a short period of time. So as an investor, it really pays to follow this approach. It's something that I learned from reading about and watching videos about Warren Buffett and how he goes about deciding whether a company is a sensible investment. And it was kind of revolutionary to learn his approach of determining the value he would pay to buy the whole company before he even looks at the share price. And so I want to give you one other way to think about investing. So let's say we've decided this was the price that the company was worth on a per share basis. Well, it's great to pay a fair price, but even better, if you can, is to get a margin of safety when you purchase stock. And a margin of safety is just a margin where if your math wasn't, just right, if you weren't perfect in figuring out what the whole company was worth, or if you just had bad luck and the stock market plunged after you bought your shares, you'd still be protected because you'd be buying it below what you think the fair value of the company is. So just as an example, if you were to buy shares of Starbucks, but instead of paying fair value, you were to get a 20% discount, okay? I'll just draw this here. 20% discount for I'm just going to put MOS, margin of safety. The share price would be $44.44. Now, this seems like a pretty low price compared to where it is now. Okay, it would have to drop about 11 bucks a share, which is a lot. But as an investor, you have to realize sometimes things happen in markets that you can't predict, that don't even make sense sometimes. And as you can see right here, in the last 2.5 months, from June 2nd to August 18th, the share price dropped 18% from 64 to 52. So if it were to fall, I'm not saying that it's going to happen, it's likely to happen, but if it did, you'd be able to buy a share of Starbucks stock for 20% off. That would give you a nice margin of safety. In case something happened, you'd be buying it much cheaper than you think the fair value of the stock is. And I'll just I'll show you what it would be for a 25% discount. You'd be buying Starbucks shares at $41.66. This approach to investing is called value investing. It was kind of conceived by Ben Graham. He wrote a book called The Intelligent Investor, which you might have heard about. That book inspired Warren Buffett to learn more about investing, actually taking a class with Ben Graham at Columbia University. And in The Intelligent Investor, chapter 20, Ben Graham talks about the margin of safety and says it's crucial. It's just a really important concept in investing. And so it's just something that will really help you out and keep you from losing money, which is really one of the most important rules, or the most important rule in investing long term, is not to lose money. And a great way to avoid doing that is to give yourself that margin of safety. So I hope this info here is helpful to you. Just full disclosure, I do not own any Starbucks stock. I hope that if you have any questions about what I've talked about here, feel free to just put the questions in the comment section below. I will read them and I will answer them. If you like this video, please give it a thumbs up, and you might even want to subscribe to my channel. So thanks so much for watching, and I will see you in the next video.